Welcome to Insights. I'm Eric. Thanks for stopping by. We're going to do a short discussion on corn, soybeans, and wheat today. We'll call it the grains review. We're going to keep this one open. It's important to understand that these three markets are related to one another. You can see them down here in a graphic that we talk. This is what the computer studies and looks at longer term. We don't have this inside the normal matrix, but we talk about these in the reports. Soybeans is still the leader, and it's pretty obvious. It's the only one with the primary trend. BU for bull, BR for bear. It's the only one with the primary trend that's up. Still producing a profit. It's the leader, and you can see the correlations here. Some things that they move around. This is a dynamic. The interrelationship between these three markets is dynamic. It changes, leadership changes, and it's important to know who's leading. Whoever's leading is the markets that we tend to focus on. What we want to talk about in terms of timing has to do more than the individual assets that we follow. A lot of time people focus on corn and then they kind of just put the horse blinders on and are absolutely focused on whatever they're looking at. And in the case of the matrix, it could be 3 time frames, but it could be there's a lot else that's going on. And we're not just talking participation in energy builds and other things. There's other cycles that come into play when studying a trend. First thing we do is we study and we find out what the leader is, and then we keep a close eye on that leader. And the leader right now is, according to the computer, soybeans, and everyone was thinking this leader is going to crash down because the other two markets were coming down, and that's part of it's a decent explanation. It's part of the explanation, but there's other things that are going on, and this is what we brought up in the commodity energy report, which we updated yesterday. We've talked about numerous times in the economy and stock report. And unfortunately, people who focus on these markets only, they miss other discussions. Everything inside the matrix is related. There's different markets. You can learn to read markets. You can learn to read how the stock market influences all these other markets as well. And it's really under the broad category of risk on, risk off discussions. There's a lot of discussions on the internet, but those discussions just tend to sell narratives and do a lot of tail chasing, but there's not a real good appreciation of the cycles that are in play. And there's more than just the cycles that are for timing that have to do with the fractal trends, and we study 3 of them: primary, secondary, tertiary. And when primary trends is up, the trend is up, and then the composite trend, which is a function of all 3 time frames, when they are in alignment, triple up, triple down, things like that, trends get focused, they tend to take off, and they tend to move. And you can see the triple down here, but soybeans double up still. Corn is not particularly in line. That's usually what takes place when a market is starting to try and make a move down or in an indecisive phase. The primary trend is down, but it's not making any money. The wheat is more organized. It's been down for 6 months and 14%, but it's more organized because the 3 time frames have been organized longer. But again, there is more than just what's going on than the tertiary and secondary and primary trends inside the assets and the energy builds and all that. There's also economic cycles, the daily timing cycles, but then there's the broader economic cycles. And the latest commodity and energy report, we've talked about how there's an important change, a change we've been registering and discussing for multiple sessions in the ES, or the economy and stock report. We finally pulled it over into the commodity energy report, which I would say that if you're trading any one of these grains, those 2 reports are pretty important to understanding how all markets are interconnected. And I know a lot of people think that that's a bunch of BS. It doesn't work like that. Markets respond only to fundamentals. They personally, you just haven't traded markets long enough or had this information in front of your face to see how there's extreme similarities between markets. We talk about it particularly in terms of the commodities and grains. In terms of the commodity energy report, economic cycle goes up, and then you have confirmation through the EAC, and then you have the confirmation through the stock market, and then you have confirmation even from the internet and the timing models that are right down in here. I'm not going to go into that because this is going to go too long, and I want people just to get an overview of what's taking place so that they get an appreciation that the corn market or the soybean market isn't just trading off of solely its fundamentals. I know it's an easy narrative to sell, and that's something that the commodity market will struggle with, probably for forever, but you have to become an expert in trading markets first, and then the fundamentals next, and then they kind of I don't know which one really complements each other more. I actually don't follow much of the fundamentals because the market is just too fast. It's looking at things that are too far in advance for the usefulness of fundamentals. Fundamentals look behind us and they just don't help us in the moment as much as people think they do. And I'm sure that tears down a lot of people's worlds, but that's what trading and that's what following the invisible hand is all about. It's just sending our egos to the sidelines while we really try to understand what's taking place. So we talked about in terms of timing, it's all three time frames. It's the economic cycles. We've established that the economic cycles are changing. We've talked about these in other reports that would most definitely complement the corn, soybeans, and wheat report. And you can go check those out if you want to learn more about what's at stake and whether or not these turns are structural, or they're going to last a long time, or are they just temporary? And that's important to understand. And without that understanding, when these trends flip up or they're maintained in soybeans, you'll just assume it's going to last forever. And it's a lot of people make that mistake. The other cycles that come into play are economic, and as we said, economic like we have here. You can see those better in other reports. We also talk about confidence in the ES report. Confidence is either cycle on or off, and right now you can see these red stages, and actually there's a cycle within them. You can see the upward movements, and this is price of gold. This is the stock market, and when there's heavy bear phases in confidence, and the confidence is really established by the LTCO. This blue line, which I pushed over, is the commodity or spot index. That's something else. It's too much information right here to talk about all at once. The whole point that we're trying to get at is we're in a bear phase of confidence right now because we're in a red box, and we're in a bear phase of overall longer term, and this is really generally for commodities. See, there's cycles. There's all sorts of cycles that are taking place simultaneously. It's important to know if you're a commodity trader and you're desperately waiting for this box over here, and that will come at some point. It's just something that it's all part of a longer cycle. But why would soybeans and why would these other markets take off? Well, there's timing, and you can see the daily timing cycles are turning up and breaking out for corn and soybeans, so that changes everything. It also what's taking place in the currency markets, which we just talked about in the dollar report, and mostly that's related to the economic backdrop, which is definitely changing as well. So that's what's taking place in the grain market. It's not just a matter of whether we have a primary trend up and down. Those you can follow and do a pretty good job. But at times, markets turn unexpectedly because there's dominant cycles underneath that are unrelated to the grain market or grains market, and we talk about with corn, soybeans, and wheat, and all of a sudden it's down and then it turns back up. Well, March is a pretty important inflection point that should really pick up steam here in May, and there's different reasons for that. And you can see the correlations between the grain markets that are here, 0.92, 0.75, 0.92. These are longer term. These are long-term cycles that go back to 1840 and even longer for some markets. If you have a positive movement, really, if you can't drag soybeans down, it's going to be tough to drag corn down. The corn and soybeans correlation is 0.92. The corn wheat correlation is 0.92. Soybean wheat correlation is 0.75. They're almost all in the same spot at one time. But the leader is still in the bullish category, and that wouldn't be a big deal. It probably is going to get pulled down. But the EAC, which is down here in the matrix, and I'm not really going to talk about too much, I'm just going to point out it's got two numbers, the ITCO, the LTCO. We talk about this in the commodity and energy report, economic and stock report as well. This has turned higher. I know a lot of people said, well, that doesn't mean anything. And I've done this long enough to know that the EAC is a leading edge tool that marks where future direction is heading. All the recession talk is really a wasted time as long as this number is positive. And if it starts to pick up, It's even more of a waste of time, and then all the bears are going to scramble and move in the opposite direction. And they have a big influence on the corn market and wheat market and the soybeans market and everything else that's in here. Explains one of the reasons why probably sugar is taking off. And we have a sugar report that most people missed and are not participating in probably the primary trend, but it is also taking off as well, much further advanced than these markets. But it's something that it's related. Sugar goes somewhere, it's probably going to reflection of the commodity market, and the general commodity market is down here. We follow it in the commodity spot index, which is 21 spot commodities. It's still below zero. It's still in a bear phase. But if that turns higher, the path of least resistance for all commodities is going to turn higher. And that usually takes place and follows closely of where the economic cycles lie. And it's really important to understand where those economic cycles are and the changes that are taking place within them. Those are things we talked about in the economy and stock report, which is an ongoing report. We also talk about them in the commodities and energy report, a recent update. I hope everyone who's tracking these grain markets watch the latest one. Try not to keep everyone off guard. I know these reports, they could all be included into one big umbrella, but it's a huge time commitment, and then the cost would go up, and I'm not sure everybody is interested in that. Some people only trade certain markets, but I'm thinking that if these markets are definitely on your radar list of importance, those are two important complementary reports that will help explain not only short-term timing, but longer term, and it will help explain whether any uptick in commodity markets here is going to be considered temporary or structural or longer term. And you have to understand where the commodity cycles lie for that. You have to understand where the economic cycles are. And those are things that are difficult to ascertain from the three time frames alone. The invisible hand doesn't get burned on the three time frames too much, but sometimes when things change and you're thinking, well, why did that change so much? Or why are these energy builds like this? It is important to understand where those outside cycles lie. If you have any comments or questions, let us know. If not, check out those other reports that are in play too. And if you have any questions on those, let us know too. If not, keep an eye on these markets. Change is common, changes in the air, the economy, stock market, things, and it's not what social media and the talking heads are addressing. They're all standing on the wrong position. The majority is rarely right. The talking heads sell to the majority. You need to be in the minority, and the minority needs to think not only in terms of the fractal trends, but also the supplemental cycles that exist outside in the world that few people follow.